we got Europe, we got South Central America, we got across the US right now that are here to learn and listen from you, my brother.
No, I appreciate it. Thank you so much. Well done for everyone making it onto the call. I understand it's a holy day for some of us, for everybody else, it's kind of quarantine as usual. But today's cool. I wanted to provide some real value. Matt's been a good friend of mine ever since I've come into the business, ever since I popped out to Miami for the first time, almost over a year ago now. And he's always shown an immense amount of love. And I wanted to kind of open your minds up onto a variety of different ways to trade. And for myself, I've been in this industry now for nearly 9 years in October. And there's been multiple different kind of stars. There's been multiple different elements and information that you pick up along the way. And it's really about kind of finding the narrative within the overall trend and kind of hoping to utilize that information as best as possible. Now, for anyone who doesn't know, I'm the co-founder and creator of one of the products on the platform called Steady. The aim and ambition on Steady is actually to provide the value and the education element first. So whether you like to build within the business, you can use the product in itself to actually help you build, as people will come in and they'll learn the information off the bat. And it's something that I'm doing currently as a complete educational series. That is something that I'll be happy to show you as well. But the aim is to actually kind of create sustainable and independent traders. It's the ambition for me to come into the company was to keep the longevity of the business going. And when Chris called me up and I said, this is what I could do for you, we instantly kind of built a partnership and worked together from it. So I appreciate that a lot of you guys are coming in from kind of whether it's East Coast or Central or Canada. It's definitely all on my list as soon as this quarantine is over that I'm going to pop out there and kind of do 2 to 3 day physical boot camps, okay? Physical in-person boot camps, whether it's Montreal, whether it's Toronto, Calgary, Vancouver, Miami, Dallas, wherever you are, that's the ambition. And that's what I was planning to do before all of this, pandemic occurred in itself. All right. So appreciate you guys jumping on board. What I really wanted to do was actually kind of go through a trading plan for some of you. Now, the information that I may offer may be completely brand new to you. It may be a concept, or there may be concepts that are completely different to what you've been taught or what you've learned in the past. And the reality is that so much information is forced upon you in a way for you to get manipulated within the market. So combining kind of clean retail perspectives with institutional order flow and understanding, we can paint a picture that is yet very, very efficient, but is completely sustainable and for you guys to understand and then replicate it. There's some really good traders out there. There's some really good educators out there. But there's not that. It's very, very difficult to find a combination of someone who can actually deliver information in a way that is firstly obtainable, and then for you to actually go ahead and then regurgitate that information and apply it yourself. So Steady, our aim was to create kind of a long-term vision, independent, self-sufficient, sustainable traders. We have the platform where we offer trade ideas. We have the platform where we obviously go live with multiple different educators in both Spanish and in English as well. So I appreciate you guys for all jumping on board. If you don't have a pen and pencil ready, if you don't have a laptop or somewhere to make some notes, I would really recommend it if trading is something that you genuinely enjoy. I know there's people here that like to use trading as the vehicle for their business moving forward, but if you really are looking to kind of step yourself up in the actual trading world and start to find yourself becoming more consistent with your results, today's call might be something very, very helpful for you. It's not for you to fully understand everything that I say. It's to open your mind up that there is a deeper inner working and understanding of how the market is being delivered in a very consistent and systematic way. All right, the market is continuously being delivered in a format. Now, no matter what time frame you're working on, whether it's a monthly all the way down to a 1 minute, price is being delivered again systematically in the exact same way. So if you understand that, you've technically got the cheat codes of how the market is potentially being offered. And once you've built the narrative and the direction of where you're trying to get to, then we can start scaling in, taking multiple entries on a singular trade and leveraging the position like that. So again, if everybody could just stick a 1 in the chat, if you're able to see my screen, that would be fantastic. Just so I know we're all good to go and we will kind of go from here. Amazing, I'm getting some 1s in here. Now, as much as I love being on the screen, I pull some funny faces when I'm analyzing or whatever. So at some point, I may begin to kind of close off that video that I can see my beautiful face up there already. So guys, what I wanted to talk to you about today is going to be about 30 to 45 minutes. I didn't want to come on here and talk about the product and talk about how good it is or anything like that. I genuinely wanted to come on here and provide some actual value for you guys to maybe take away from, pique an interest, and then understand what we're looking to do over on the Steady platform itself. So I'm going to come off of this one. I'm going to work on an empty chart over here. So the first thing, all right, I want you guys to write down. Now, many of you may be successful in your own right. You may actually have something that works for you when trading. What I'm looking to do is give you a different perspective, combining 7 different concepts together to ultimately find the most optimal entries for the most minimal amount of drawdown for the most extended amount of time. All right, so the most optimal entries where we see price react almost immediately and systematically, no matter what time frame. We look for obviously the most minimal amount of drawdown as possible, so our stops remain quite small. And we're looking for those extended targets. So in theory, we are looking at us being swing traders. If you haven't understood or don't know what swing trading is, I don't see swing trading as a period of time, more so than the risk to reward element. So you could be looking at something that might be a 1-to-1 or a 1-to-2, where you're risking 50 pips to go make 50 pips, or you're risking 100 pips with a stop of 50 pips, so a 1-to-2. What we like to do on average is a 1-to-3 to 4 minimum with extended targets and TP2s and TP3s of around 1-to-6, 1-to-7 into 1-to-10s and so on and so forth. And you'll see how once you start to identify these things in certain ways, that they're very, very easy to do. And I really, really promote that you understand risk to reward profiling, because this is the most important thing in terms of finding longevity within the market, is that you understand that you don't have to win every single trade. Trading is not about winning every single trade, because again, the reality is nobody actually knows where the market's trying to go to. We can have short-term projections, we can have medium-term projections, we can have longer-term projections, but the reality is, I don't care who you are, no one truly knows the exact direction the market is trying to go in. So it's our job to find the position within the narrative of the trend. And this is what I'm hopefully going to kind of provide for you today, or at least pique your interest in, and then for you to kind of go ahead and utilize the platform or the education as best as you can. So we're going to start talking about kind of a trading plan. All right, a trading plan. Oh, let me put this all in capitals. Trading plan. And we're going to have 7 different steps in this, and I call this an elements to a trade setup. I will try to run through it fairly quickly so I don't take up too much of your time. So here we go. So step 1. From my experience, when you're first coming into the market, or when you're kind of in that newer stage, or when you're still in that intermediate phase, sometimes it can be quite daunting to come over to a market and say, right, I know exactly where the momentum's going. I have a theory of how I should be getting to certain levels. I need to find a directional bias, and therefore then I need to scale it into finding an entry. Now, doing something like this is going to be really, really beneficial moving forward. So the step 1 that we always like to talk about when trying to identify market setups is going to be the wave analysis. All right, wave analysis is so important for us to even, very, very simple, and I'm sure we all understand it, but to identify where we are in relationship to the trend. Are we in highs? Are we in lows? Are we in the middle of a trend? Are we floating in an area that wouldn't be an optimal region for taking a trade? We can look to utilize that, and every time I step down to the market, I'll always try to look for these on the weekly and the daily time frame are going to be your highest probability in terms of deciding where the overall bias of that trend should be going on. What I will say is, if you ever find yourself lost in the market, step yourself back out to this daily time frame and understand that the daily time frame in itself is going to be the highest probability of trend direction. Okay. In itself, we have to be able to identify what does create a trend. We have to have 2 points of swing to be able to establish a trend. We look for those third highest probability swing highs or swing lows as our, again, our highest probability of execution. So there's multiple different formats, and I have done a complete video series, educational series over on Steady for you guys to kind of digest all of this information. But when you first come to the market, we should be looking at the directional biases of where we are on the trend. So very, very simply, if I just kind of whip everybody's faces to the left a little bit, we can clearly see on something like EURUSD for a period of time now, for about 2 years, 2.5 years, we've been extensively in a very, very aggressive downtrend. Okay, we've had some wild formations of price here and here, of which was there to kind of manipulate in certain ways, clear out liquidity, and then draw on a seek and destroy element. And we'll talk about that in a second. But every time I come to the market, we have to identify where we are in relation to the trend. Am I near the top of the trend? Am I near the bottom? Because the first thing I like you to say or to write down is it's so much more important about where something is than necessarily what it is. So the relationship of where we are in correlation to the trend is so much more important than necessarily what is being delivered by price action or candlesticks. Because everything you've ever wanted is on the other side of fear. And if you utilize that concept when trading, you'll find yourself getting into the market when others are fearful and getting out of the market when others are greedy. And we all know how that works out, whether it's the cryptocurrency space, whether it's the equities, whether it's whatever you're looking at. People jump on the bandwagon and then immediately price drops back. So we, from now on, will always be thinking about getting in at the lowest point possible and getting in at the highest point possible. But it's all dictated from understanding our first element, which is understanding the overall waves. Now, probably contrary to what you've know or talked about or heard in the past, the market is only trying to do two things. Okay, it's only ever trying to do two things. If I talk about that, seek and destroy and rebalancing. So it's only trying to do these two things. And if we can understand the different concepts within those two sayings, then we have the whole perspective of what the market's trying to do. We are either trying to seek and destroy, or we are trying to rebalance ourselves. The market is continuously trying to be hedged in an even manner. And what I mean by that is big institutions, big hedge funds, big equity firms, even central banks. They have to evenly hedge themselves in a certain position. Otherwise, economies would crash if all money was leading into one particular direction. And sometimes when you see those major spikes, that's what's happened. And when they talk about the algorithmic format that that's happened in, that's a whole different story altogether, but we can get into it. I just want you to know that the price is always looking to rebalance itself or seek and destroy. So once we've identified where we are in relationship to the trend, we're using the daily time frame to find the highest probability of trend direction. The second phase that I like to talk about is true. Okay, very, very important. True support and resistance. I'm sure some of us obviously understand support and resistance. We find levels where prices bounced off in the past. We find the floor where prices bounced off before. But again, how many of you have placed on a support or resistance? And again, just to open your minds up, in theory, what is support and resistance? Who determined that this level was a support? Who determined that this level was a resistance? The same way when you apply a trend line, who determined that the trend line starts there? It's a different way of thinking. True support and resistance is using the theory of seek and destroy and rebalancing. So rather than finding a low or rather than finding a high that we should respect because we've left that level before, I promise you more often than not, you will find that those levels get rammed, your stops get taken, and then we move in the right direction. If that's ever happened to you before, this might be kind of the processes for you to understand, actually, okay, I understand why I'm starting to get stopped out in certain support and resistance. So phase two, we have to understand true support and resistance. And just to explain briefly what I mean by that. So if I was looking at kind of the market just in this theory of price, typically we would be saying, right, that's support because it's left the level. This would be support because we've left the level. This would be resistance because we've left the level. But on every occasion where we've come into it, we've ran it. Every time we've rejected from it, right, that will be my new support because, you know, price has left him here. Here's my resistance. Let me take a sell here because price left there before. Price ran it. The same way, right, well, we've got one support, we've got two support. No, price goes and runs it. You're always being manipulated into a certain stylistic way of trading. And I'm here to obviously show you that there's a different way and different theories in trying to do that. So if I was, oh shit, sorry, let me move this quickly. So if I was to talk about true support and resistance, what do I mean by that? Now in areas of price, where we've only been offered in one direction, like I said, if some of this information is completely brand new, that's the point of this, just to open you up to a whole new idea of trading. Now in areas of price, if there's been only offered in one direction, this market is what we class as inefficient price action or imbalanced price action. Because the market is constantly trying to hedge itself, so we are equally traded in both directions. But if we are only offered in one direction, then the market is more often than not going to continue to try and rebalance itself and coming back to those levels. So a very, very simple scenario. Price should have used this as support from a technical standpoint. If I scale this out, just flip the time frame, can we see on this single candlestick, the last time that price was being delivered in the recent time zone in here, we've got an area where price was left completely open. From here to in here. This is what we class as inefficient, where no candlestick body or at least 50% of the candlestick wick has filled in that level. Therefore, only buying pressure was delivered in this manner. And therefore, the market will want to come and rebalance itself by hedging itself back towards those kind of levels. So this is where typically we might be using something like this low as a support region. Lo and behold, price absolutely melts through it. But what can we understand true support and resistance for? By identifying areas of imbalance from the past, we can see how price likes to respect. Can we see how accurately true support and resistance has been respected? Because this was the last offering of price in a singular direction, and then we overbought ourselves to one side, and so on, and price absolutely rallied to the high. Typically, this should be some kind of resistance, right? This should be a resistance. If we were working with support and resistance that you know, price goes and absolutely obliterates it, okay? Now, if I go ahead and delete that, the next point for me, just by looking at what we've talked about again from true support and resistance, can we see how we've already touched this price in here, so we've rebalanced the market. The next level for me would be around here because that was the last time that price was offered in a singular direction. So now, if we were thinking about the old perspective, you would be saying, right, this must be some kind of level of support because we've left this region of price before. What happens? Price immediately runs through this level and respects and responds to what we understand as true support and resistance. This isn't for you to fully understand on this exact call, but it's to open you up to understand that there is a deeper meaning and deeper perspective within the market to say, right, okay, cool, actually, there is something going on behind the scenes. If I look for imbalances, if I look for seek and destroy, and I look for a rebalanced market, I can start getting in at the most optimal areas of in price. So step 2, when I come to the market, I've dictated where I am in relationship to the trend. Lower lows, lower highs, lower lows, lower highs. Step 2, I'm looking for the understanding of true support and resistance and in forms of inefficient price. Step 3, we look at candlesticks, price action on multiple time frames. Candlesticks and price action on multiple time frames. So we've already understood where we are going in a trend. Step 2, we're looking, can we get to a level Are we near a resistance? Are we near some form of support? Are we in an area of supply? Are we in an area of demand? Step 3 is when you've identified where you are and where you want to get to, is you use the candlesticks as the language of the market. Please don't let that go over your head. Candlesticks are a true reflection or a visual perception of order flow. All you're seeing on a chart here is the visual perception of buyers and sellers dictating where the market's trying to go. But if we can understand from a monthly, weekly, daily, 4 hour, 1 hour, whatever different time frame you're looking at, what the relationship between a body to the wick to the directional bias, and we can use that to create an entire blueprint and use that the same way you might learn French or the same way you might learn Spanish or the same way you might learn English. If you can understand what the relationship of the shape and size and the directional bias and what it's trying to tell you is with the candlesticks, you've already created the overall blueprint. We now just need to scale that thing in to understand where we're trying to get to. Now there's going to be 10 or 12 different candlesticks that I look to utilize. And it's actually going to be this week that I talk about candlesticks in my Elements to a Trade Setup course series that I'm doing on Steady. So I won't talk about all of them here, but just understand that the next step after finding waves and where we are in the market, we look to understand from multiple different time frames how we can get to those levels, because the candlesticks are the language of the market. Step 4, a concept that we might not be familiar with. I look for something called sorry, my spelling's not great. Accumulation and distribution. Accumulation, distribution, and console. Yeah, excuse the spelling, not the best. Right, so step 4, accumulation, distribution, and consolidation. Now, what I mean by that, before going into the entirety of each different concept, that will be in phase 4 of the educational series, we have to understand that every single market, anywhere, whether it's stocks, indices, commodities, or currencies, begins from a period of consolidation. Okay, so every single market begins from a period of consolidation. We only have to look back and start seeing, yeah, if I just looked at here, we can see how on this pair specifically, consolidation, boom, impulse move lower. Consolidation, boom, impulse move lower. Consolidation, boom, impulse move lower. Consolidation, impulse move lower. And the reason why that has to occur is because that is what accumulation and distribution is. A certain direction is starting to get out of those bullish orders or those bearish orders. And then in the reversal, other investors are looking to now buy into that market or sell into that market. So we go into a period of consolidation. So it's very, very important that we understand that every single move begins from a period of consolidation. Now, what determines consolidation? I say price action moving sideways. I quite know how to word that. Price action moving sideways beyond 3+ candlesticks. So once you start going into 4, 5, 6 candlesticks that are all in roughly the same area of body of price and wicks, you're into a period of consolidation. So that now means we're getting ready to move in a certain direction. Now, if I told you we need to understand how something consolidates, or we have the ability to understand the pattern play and the formations of how something's consolidating, that helps us benefit in a way that we can utilize that information and get the most optimal points of entry possible. It's a bit like if I knew, well, in this market, if you know how something is consolidating, you know the movements that it's trying to create, you know the stylistic ways that it's manipulating itself, you know that it's taking liquidity in one direction, it's then creating a new short-term trend in another direction. We then always look to be buying in at the lowest price possible. we have the ability to start attacking those markets. And this is something that we class as Wyckoff schematics, where we've got schematics 1 and we've got schematics 2. All this information is available over on Steady, but just understand in phase 4, once we've dictated where we are in the trend, how can we get to a certain place? What are the candlesticks trying to tell me? Now I'm gearing myself up for entry opportunities. I come to the market and say, right, every move begins from a period of consolidation. Doesn't matter what time frame, because price knows no time. And that might be, that one phrase there might be a difficult concept to get over, but price knows no time. Price is systematically being delivered in the exact same way, whether it's the minute time frame or the monthly time frame. You just have to understand what you're looking for. Step 5. Let me move this over. Boom. I look to utilize the Fibonacci tool, but not in a way that you may have been taught in the past. We use Fibonacci, yes, to identify where we are in relationship to the trend. Right? If we were looking at Fib here, typically the easiest way for me to explain this on this particular call is Fib helps us identify where we believe the next significant wave should occur. Right? So Fib, we look to identify the first impulsive leg, use the measurements and distance within that leg, and use the Fib in particularly these areas between 71 and 88 as optimal areas of retracement. And it's not because of some numerical number ratio, okay? If you've ever heard that before, it's not your fault, but it's not because of a numerical number, right? It's not because of that, the Fibonacci sequence. It's not. What we're looking for when utilizing the Fib is that in this extended rally to the downside, we've had our first impulsive leg, but you've gone from an area of kind of premium price all the way into a discounted level. So you've almost oversold yourself. We never want to be jumping into a market when we're at the base of it, do we? We always want to be selling higher and buying lower. That one phrase there changed my whole entire trading career. And it might seem nothing to you, but it changed my whole entire trading career. Every time I come to the market, I'm always like, oh, could I sell higher? Could I sell at that price slightly higher? I've seen a nice 4-hour candle. I don't want to get in at the bottom of that candle. Could we expect a retracement? So yeah, Fib, I'm always looking for optimal regions of price trading in between the 71 and the 88%. The reason for that is once we trade into at least 50%, this means that price has now come back to a fair value. It's come back to an equilibrium price point within the cross currency. So euro against the dollar has come back into an equilibrium price point of which is fair value against its cross currency. So we're not at an overly priced market to the downside, and we're not at an evenly discounted market all the way up here. So I'm telling you that bigger players in the game are always consistently looking for these levels between 71 and 88. You could even maybe throw on the 62%. I prefer not to because I like to be at the most optimal points possible. But you're looking for those levels. Why? Because you've gone then beyond 50%, which means price is now at a fair value against each other after having an impulsive leg to the downside. And we're starting to get it in at discount prices. Why buy something at the top of the price range when it then goes and increases itself? Why buy something at $10? It goes to $15 when we can get it at kind of $6, but over a period of time, we've analyzed it and it's going to go push itself to $20. Why would we want to do that? Why would we want to get it at $10 here where we can save ourselves a bunch of money by retracing back to those price levels? So anyway, the simplest way to identify Fib is it allows us to create a zone of price where we think the next level of swinging opportunity will occur from, no matter what price. We're nearly there. I appreciate you guys tuning in. Now, step 6, we're going to be talking about time and price. One of the most underrated, underappreciated forms of analysis that you could ever do is understanding that correlating time and price together will give you the majority of the trading range, the trading day, will help you with the weekly schematic of price, the geometry of price, how price moves on specific days in specific ways. If we know that kind of on a Monday, we're not usually going to create the high or low of the week, then why are we trying to sell something at a level? Could it get slightly higher? If we know that often Fridays are going to create the high or low of the week, depending on the trend direction, why would we then want to continue that overall bias when we could expect some form of retracement setting us up for the week ahead? There's very, very specific times we need to focus on. Just for this webinar right here, I want you to focus on between kind of London is one of the highest, is the highest volume that's created in a daily range. So the most amount of orders are being processed through a London period of time frame. And if we know that we can get kind of potentially the low or the high of the day, during that London, we've got the entire day to run that trade to the one direction. So 70% of the time, we are looking to create the high or low of the day during London, especially if you're trading a kind of a European or a pound pair or a Swissy pair, something like that. More often than not, you will create the high or low of the day during the London session. London, for me, is going to be between 6:30 a.m. I'm over here in London, so that's GMT, till 10 a.m. So I now only need to be entering or looking for entries during those time zones. Now, I understand you're out in America, and that's absolutely fine. And personally, I prefer trading what we class as the New York session, which for me is between 12 p.m. GMT to about 4 p.m. GMT. Right, so 70% of the time, we're going to create the high or low of the day during London. Between 6:30 and 10 a.m., I'm looking for my specific entry and reason as to why I should take that trade during that time frame. New York session, the reason I like to trade it slightly better than the London session is because we've generally already been given a directional bias during London. And so New York or East Coast timings, as you wake up at 7, 8, 9, 10 a.m., we can then just look to scale in the time frame and say, okay, cool, I've been given a direction. Now let me utilize the specific entries that I'll give you on step 7 to find the trading continuation format. So these are the times. Now, you don't have to be glued to your computer. You can be looking at times during these sessions. And then once you found them, you let them run for the period of day, for the period of time. Maybe it's for the rest of the week. It's entirely up to you. But remember, there is also a weekly schedule as well. So you should be looking for, more often than not, 70, 80% of the time, Tuesday to Wednesday morning is going to be the high or low of the week. Trading that into Friday, Friday morning, Friday afternoon, you're looking for the high or low of the sessional week as well. Sounds obvious, but a lot of us don't actually kind of take this into account. Finally, step 7. Order flow. I'm going to do an example to bring this all together for you. And like I said, please don't be overruled by a lot of this, if some of you might not be, but I just wanted to open you guys up to a different kind of stylistic way of understanding the market, true understanding of the market. So step 7, finally, we've got order flow and manipulation. So we have to understand that this market's heavily manipulated in favor of those bigger institutions. As retail traders, no matter how many people you think is in Iron Mastery Academy, no matter how many Instagram gurus that you find, no matter how many retail success stories you may see or follow on Instagram, which is a whole different topic altogether, we own pretty much 1%. 1%. So a bit like that cash flow quadrant, if 99% of this market is being owned by probably the 1% hedge funds, banks, and central banks, why would we then not want to trade like them? Right? Why would we not want to trade like the big guys? And I'm telling you, this is how the big guys are trading. I've been in a position, I've been in 4 years of a trading institution. I've then worked as a stockbroker. I've then worked within the Shard Capital Trading Group. I've been in positions of higher education formats to understand that this is actually the true understanding of market and time and price and order flow manipulation. Now, very, very simply, understanding order flow and manipulation is the fact that price is being delivered systematically. Okay, please don't let that go over your head. Price is continuously always being delivered systematically in two formats. You're looking to seek and destroy. So you're looking to grab liquidity. Liquidity, wicks. Wicks, money. All right, that's that whole concept. Is there an area of relative equal highs? Is there an area of relative equal lows? Is there singular wick highs? Are there singular wick lows? That means money is now trapped above these levels or below these regions, and price is going to inevitably seek and destroy to grab that liquidity before going in the opposite direction. And second, when we look at order flow, price is then being delivered in a very unique and systematic way. The first, again, I don't expect you to get this straight away, but one of the best ways to identify where has a big market maker or a big institution look to deliver price, we're looking for price to be delivered in one particular direction first, and then immediately go in the opposite way. And why do I say that? So I've got blue and black here. Let me just color this in black. And why do I say that? So bigger institutions with the amount, I don't know about you, but I've seen $1 billion order, a 1.1 million lot size order. If anybody knows and understands what a lot size is, a 1.1 million lot size order, which I've physically seen, is $1 billion order. Imagine that. We're all sitting here trading 0.1, 0.5, 1 lot, 2 lot, 3 lots. I've seen a 1.1 million lot order. But can you imagine the amount of money that they're trying to filter through these markets? They cannot get all their orders on at one time. The market would just collapse. The economies would just collapse. Fluctuations. No one would be able to sustainably hold any formation or economic projection if we didn't have this. So what are they trying to do? They're always looking to rebalance themselves. And this is what we look for. We look for traces in market momentum where price pushes itself in one direction in order to sell a market where they're looking to use maybe 2 million of risk to make 10 million in the opposite direction. But what they're not doing is then allowing themselves to actually take that loss. So what price will often do, and what we base everything around, is the fact that price has been delivered very systematically. We've sent the market in one direction before heading immediately in the next direction. A great sign and understanding of how the market's been manipulated. We now look for areas of price where we retrace or we mitigate back into those zones. And this is where these big players are looking to now get out of those selling positions that they've evenly hedged one way before buying it in the opposite way. And this is what we class as kind of mitigation, in a way that price has pushed itself away, and we pull back to the signs and traces of manipulation that have been left in the market. All right, and then this is where we're looking to compound everything that we've talked about in the past over here, waves 2, 3, 4, 5, 6, and 7, and how we can kind of talk about finding an entry. Let me just take a quick look at the chat box. Let me just bring this over here. Cool. So just to round this all up for you guys, I feel like there's been a fairly positive session already. Let me show you something that was kind of helps bringing this all together. Just need to refresh. So we have our different trading plan. We have step 1 to step 7 of how we should come to the market and understand where we are in relationship to the trend. Yes or yes. So if we, actually I won't delete that just yet. So there's our trading plan. So if I just kind of replay something, as this was one of our positions leading into convention. Actually, it's just a great example of talking about what we were trying to do. So contrary to what you might believe in the past, something that I'm always continuously thinking about is buying below old lows and selling above old highs. Why? Because that would be the draw on the liquidity that I'm looking for. I can correlate it with all the other confluences that we've talked about, but essentially I'm always looking for seek and destroy to occur before then getting back into the market. We don't have to be first in the market. So many of us try maybe pick a top or pick a bottom, and it's never actually been the top. or the bottom of the market that we've looked for. All right, let me go ahead and clear some of this. So looking at the wave direction on EURUSD, we can clearly see from a daily perspective, the same way it would be on a weekly perspective, that we were in a lower low and lower high swing direction. The market has pushed itself lower. Once you've gone and created that lower low past this point, what do you think the market has to go and do to at least kind of rebalance some of that price? Remember, price was only offered in one direction down here. So that's unevenly traded price. So the overall sentiment is that at least we could come back and get ourselves back up into some of these higher levels. All right. Typically, we broke through there, we could look for at least a retest. So keep it very, very simple. But the overall direction is that we've made a lower low. So we should be looking for at least a lower high. We go ahead and look at maybe true support and resistance, which is coupled with imbalanced price. Let me go ahead and get rid of that. We can see that we like to use the most immediate time frame or the most immediate price where we're coming looking to retest. So we can see in terms of true support and resistance, we've dictated that we're a lower low and we're coming towards a true level of support. Why? Because that would evenly trade in this area of inefficient price. See how price reacts from there. We go in, we tap it, and we close the week out. Come back into the day. Step 3, right? Step 3, we're looking at candlesticks, price action across multiple different time frames. I'm still at a lower low, but we can see how price action in here, right? Price action in here has aggressively moved away to the upside. Now, this is something that we class as a bullish engulfing, which is a candlestick that in theory has taken all the momentum from the previous candlesticks in days and cleared it out. So we can see that this candlestick here has taken out or engulfed 1, 2, 3, 4, 5, 5.5 previous days of price. Now that is a reversal signal for us. So cool, I'm at a lower low and I've just been given a reversal signal from understanding time and price action. Let me scale into this, because what are we not trying to do? I'd never want to buy at the top of a market. I always expect some form of retracement. So as I step this time frame lower, we can start to see price was kind of moving sideways, wasn't it? So step 4, accumulation, distribution, consolidation. Let me set this thing down even lower. Drop it into the 1 hour. What we can start to see is that price is accumulated in a very specific way. And I know I haven't gone into that, but price is always looking to accumulate in a very specific way. It's looking to create an area of liquidity, a buildup of pressure. It's looking to help and signify that buyers should be entering into the market. We know that because we're at a lower low. We also know that because we've come and hit some form of true level of support. But what price is always trying to engineer is clearing liquidity before making its true movement. So looking at kind of some form of schematic, we can see how price created an area of liquidity being pulled below this rejection and this rejection. We then ran through it and immediately created a short-term higher high. Price pulled back to come and create a kind of last support test of this area before rallying and again breaking short-term structure here. So we've made this new high up here. This would be the daily candlestick. Step 5, we like to utilize the fib, don't we? So looking from a bullish perspective, we could take the significant low into here and we could be looking at the significant high once we've shown a willingness to pull back. The specific areas I'm looking for us to pull into are going to be between that 71 and that 88. Step 6, time and price. Remember what I talked about in terms of London time zone? There's very specific times that the multitude or the majority of volume is being delivered. So if we expect, I talked about, so we've got 5 a.m., 6 a.m., 7 a.m. So I'm just, for ease, I'm just going to put 7 a.m. to 10 a.m. in there. So I've got a very clean window of where price should be coming into. Right, I've got a very clean window of where I would expect price to get into. Why? Because this is my London. This is my London time zone between 7 and 10 a.m. GMT. That might be between 2 and about 5 a.m. if you're on the East Coast. But we don't always have to, if we miss this entry, remember there's always going to be another entry opportunity during New York. So I'm in my optimal area. I can see prices moved away. We've left a period of consolidation. I'm at a lower low and I've rebounded off of a true support. So I'm looking for price to at least, even if you just wanted to come and take this high in here, you're probably looking at a 1 to 4, 1 to 5. The reality is we know that we can get up into here. Why? Because all we got to do is just flick through the time frames and say, right, price can clearly come and at least retest this. At least come and retest this. And this has all been derived across multiple different time frames. Now, the final thing that we talked about was understanding how price is being manipulated in one way before then moving in the opposite direction. Can we see a very obvious opportunity here where price has pushed itself to the downside and then immediately rejected back to the upside? This black candle here was where they hedged themselves in a sell position in order to balance the market correctly before taking the ideal position long. They've sold the market in order to buy it back up. But they're not going to leave themselves in a loss from this initial position. So what they like to do is they bring price back into anywhere between kind of the open and around about 50% of that open close candlestick. And that is where we create an entire program of where price should reject in the most optimal manner. So if we watch price come into here, as if by, let me go to the 15 minutes so you can see it clearer. Remember, this is 7 a.m. GMT. Bang. So at exactly 7, remember 70% of the time you're going to be expecting the high or low of the daily range being created during London. So I know that for the rest of the time moving forward, I can expect that price should start to begin a period of expansion to the upside. If I move this, which is my 7 a.m. time zone, and I move this, you can see how price came immediately into our 71, our point of interest, manipulation, and we've immediately rejected to the upside. So if I was looking for an entry on that, what I like to do, rather than waiting for an entire candlestick to form and then have to have a huge stop loss on that, we can look to take the entry on the open. The stops are going to be, I'm not going to be a hero because once you plus the spread, you're probably around 15 pips. But then the target ideally is looking at just to the highs to begin with, just as you're getting used to this. Why? Because money will be trapped above here from the selling perspective. And what is the market trying to do? It's trying to seek and destroy, or it's trying to rebalance itself. So what happened? The market rebalanced itself. So now we're on a seek and destroy mission. Now for the overall perspective, we realize that just from 57 pips, right? That might not sound a lot, just from 57 pips, we're already trading at nearly a 1 to 4. So if you're risking 1% here, you're nearly 4% up just from 57 pips. If you're risking 2% here, you're nearly up 8% just from a single trade. The reality is we know that we're looking all the way up into these levels because we're looking to hold for a couple of days because the analysis says that we should. So we're now looking at a 1 to 12 risk to reward ratio with a 15 pip stop with the possibility for 182 pips in a position that should come into fruition in about 2 to 3 days. Because I'll tell you now, I am not somebody who likes to hold something, right? I am not someone who wants to sit in something for 2 to 3, 4, 5, 6 weeks. Not at all. 2 to 3 days, 4 days, because we're looking to capture a higher amount of pips, but we're still looking to use the least amount of risk possible. So once using all these 7 different steps and these different elements, what you should be able to see is if you've risked 1% here, you could be looking at a 12% gain. If you've risked 2% here, you could be looking at a 24% gain in a single traded position. I'll step it up just so we don't waste too much time here. Get rid of everything else. We can see how we built from an overall perspective of weekly, from the waves to directional bias, from understanding true support and resistance and inefficient price action, from identifying what a specific candle meant to us and then how we could scale down into that. We then stepped the time frame down and identified that we had a period of consolidation. Therefore, every move begins from a period of consolidation. Correct. If we understand how that consolidates in a very specific way, then we can look to utilize a more optimal entry area and fruition moving forward. Step 6, we've utilized the fib to say, right, is price coming back into a discounted area? So I'm not buying at a premium level I'm getting in at the best price possible. Then I use order flow and manipulation to say, right, where is there traces? Is there traces where the market has left specific formations for me to use and enter upon? And we can see how price played out. Gone and took the high. So within a couple of hours, you could already be at your 1 to 4, and that might just be enough for you. But for us, the better you get at this kind of thing, you'll be looking to take these positions for as long as possible with re-entry opportunities around the corner every single day. So still on the, let me just speed this up. 4 hour, there we go. Clean and concise, the most minimal amount of drawdown possible with the most optimal entry region, small stop losses, and big targets means that we can percentage compound very, very aggressively. Now, I'm telling you this from a true standpoint. You do not have to win every single trade that you take. You don't. You can win 3 out of 10 and still be way more profitable than a lot of people. You can be. But it's about understanding that it's okay to take a loss if you would have done the same thing or the exact same thing again and again and again. Sometimes the market will go against you. Sometimes it will. Everybody's human. We're all seeing the same thing, but having a differing experience. And that leads us on into psychology, which I think you're in an amazing place anyway, with someone like Greenie on your side. So guys, that was it from me. I just wanted to kind of provide some value. If you're interested in the kind of thing that I offer over on Steady, it's a $22 add-on. We give you the trading setups that we find, whether it's on lower timeframes or higher timeframes. We have 2 different variations. I'm also creating a complete educational series of which I gave you the overview of just now, of which I've already done lesson 1 and lesson 2, an hour 15 minutes from each different element. This week, we will be talking about price action, how to use it, how to utilize it, where to find it, and move so on and so forth. So guys, if whether it's for you to benefit, whether it's something that you like to build your business off of, it could be something that might be of interest. So guys, I appreciate you having me on. Thank you very much. Greenie, have a blessed day, my friend.
John, my guy, thank you for your time, brother. Guys, just show real quick in this chat real quick. How much value did you just see in that call? What I'm doing right now is that, one, you better believe that I'm downloading Steady app and I'm using that to the best of my ability. I want to be connecting into John's calls as much as possible. Like, look at these chats going crazy. John, I got one question for you real quick, bro, because I'm looking through. We got 60 people on this call. We got a lot of people that are seeing success in trading, but I'm seeing some new faces as well. Just one tip of advice for the new trader that's on this call that just started their journey.
Amazing. Something that I wish I had done in principle. I'll be open and honest. I built an account of 3.2 million, lost 2 million in a day. All right, I've been in that position, so I come from a standpoint where I can openly and honestly talk about it. Patience, discipline, organization, and commitment. These 4 identities, whether it's in your life or whether it's in your trading, if you would have done the correct thing in the first place, would you have been in a far better position today than trying to flip your account and blowing it all those times before, right? Do the right thing in the first place before kind of getting into all the mess that you've done previously. So patience, discipline, organization, and commitment. Implement those 4 things in your trading. It's what we talk about time and time again, whether it's the journaling aspect, the commitment to it, the risk reward profiling, understanding it, and moving forward like that. You're in no competition to anybody. You're on your own entire journey during this process. I strongly believe who you follow on Instagram can have a detrimental effect to your own happiness. So please, please, please remember that you are on your own journey in this. This is for you to succeed in, not for anybody else to succeed in.
Bro, one of a kind, man. Thank you so much for joining up with this platform. Thank you so much for hopping on this call and just blessing everybody with some Easter eggs for their Easter Sunday, brother. This was phenomenal. We got this recorded. This will be in the chats, but fam, you have at least 60 people that are tuning into more of your calls, that are tuning into your app. And bro, we're so excited to learn more from you. So thanks again for your time, guys. Thanks for hopping on again. We are grateful, and everyone have a fantastic rest of your Sunday. Appreciate you, brother. Thank you.